Aloha, Inspired Moneymaker. Welcome back to Inspired Money. If this is your first time joining us, welcome. If you're returning, welcome back. In traditional finance, the story has always been the same. Invest to maximize your returns, full stop. But what if there's more to the story? Picture this. You're reviewing your investment portfolio, your numbers, tickers, performance charts. Everything looks fine, but something feels off. You're supporting industries maybe you don't choose to support in real life, things like fossil fuels, questionable labor practices, or companies with values that don't reflect your own. For a growing number of people, that disconnect is too big to ignore. So today we're exploring a new way forward, mindful investing. It's not just about growing your wealth, but about growing it with intention. It's about asking, can my money do well and do good? Whether it's integrating environmental, social, and governance factors, investing with a gender or racial equity lens, or seeking positive impact through public markets and beyond, this episode is about turning capital into a force for change and long-term value. We'll break down what mindful investing really means, how it works in practice, and how to avoid the traps like greenwashing. Along the way, you'll hear from leaders at the forefront of sustainable finance, systems thinking, and values-driven investing. So if you've ever wondered whether your portfolio can reflect your purpose, stick around. This conversation might change the way that you think about money. We've assembled a great panel of experts today, so stay tuned. Before we dive in, I want to thank today's sponsor. If you want to level up your investing game, listen up. For a limited time, you can get Seeking Alpha Premium and Alpha Picks. They're two most powerful investing tools bundled together for just $639 for the first year. That's a 20% discount off the regular price. With Seeking Alpha Premium, you'll unlock deep research, stock screeners, institutional grade analysis, and with Alpha Picks, you get 2 high conviction stock recommendations every month, backed by data, research, and real performance. Seeking Alpha boasts that since launching in 2022, Alpha Picks has outperformed the S&P 500. Just a heads up, past performance is no guarantee of future results, and this is not personalized investment advice. Seeking Alpha is not a licensed broker or investment advisor. And this is an affiliate link, so I may earn a commission if you subscribe at no extra cost to you. You can grab the deal now at inspiredmoney.fm/alpha bundle. That's ALPHA BUNDLE, and start making more informed investment decisions today. Now let's meet our incredible lineup of guests. Our first guest is a true pioneer in sustainable investing. John Streur is Chief Investment Officer of All Material Risk Investment Strategies, better known as AMRIS, at Boston Common Asset Management. Before this, he served as President and CEO of Calvert Research and Management, where he helped grow the firm from $11 billion to over $40 billion in assets under management. John led groundbreaking initiatives, including the Calvert Principles, the Calvert Research System, and the Calvert Indices, advancing ESG integration long before it was mainstream. He brings decades of experience and a global view on how to connect investment performance with long-term impact. John, welcome.
Thank you. Pleased to be here.
Our next guest is a leading voice in values-aligned investing. Dr. Kristin Hull is the founder and chief investment officer of NIA Impact Capital, where she focuses on social justice, environmental sustainability, and gender equality. Kristin is widely known for pioneering gender lens investing in public markets and for developing thematic portfolios that reflect the world that we want to live in. She started her career in education before turning her energy toward transforming finance itself, and she has not looked back since. Her work sits at the intersection of purpose and performance. Kristin, so glad that you made it. Ooh, you're muted.
Oh, no.
Now I can hear you.
Okay.
And rounding out our panel is a thinker and builder, challenging us to reimagine the very foundations of business and investing. Dr. Manel Pretel-Wilson is a social entrepreneur, system scientist, and sustainability leader with a deep academic background, including a PhD in system science and multiple master's degrees in international relations and sustainability. His forthcoming book, The Ethics of Human Systems, Creating Economic Value with Impact for Good, comes out in August of 2025. It presents a bold framework for integrating ethics directly into economic systems. Manel brings a rigorous values-first lens to impact investing that's both philosophical and deeply practical. And I want to give a shout out to Jed Emerson of Blended Value Group for connecting us with Manel. Manel, welcome.
Thank you very much.
So with this dream team of experts, we're in for an informative, inspiring conversation. Let's jump right into segment one.
Mindful investing integrates financial goals with ethical and sustainability considerations. Unlike traditional approaches, it may factor in environmental, social, and governance criteria alongside financial returns. Investors can use strategies like negative screening to avoid industries that conflict with their values, or positive screening to prioritize companies with strong ESG performance. The United Nations Sustainable Development Goals provide a framework for aligning investments with global sustainability targets. For instance, funding renewable energy projects supports SDG 7, while investing in gender equality-focused businesses aligns with SDG 5. One challenge is measuring impact consistently. ESG scores vary across rating agencies, and impact washing remains a risk. However, growing transparency and regulatory initiatives worldwide are improving accountability. Balancing financial returns with social impact requires strategic diversification. Understanding available data and setting realistic expectations can help investors make informed decisions that reflect both their financial and ethical priorities.
John, you helped create the Calvert principles more than a decade ago. How did that framework change your own view of investing when you first implemented it?
That's a great question. And your video we just watched mentioned the Sustainable Development Goals, which, of course, was backed by the United Nations. And whenever you're creating global principles, I think you look to norm-setting organizations like the UN, OECD, other governing institutions or multilateral institutions that we have around the world to think through the set of characteristics that are really applicable to the global commons, if you will. And so one of the things that happens going through the process of creating those types of principles is thinking about your situation, your view, your values versus the values that are going to work globally for a population base that may have little in common with yourself. So one part, Andy, was kind of going through that exercise and thinking about the impact that companies have on individuals around the world, people who will come in the future as well, who may have nothing to do with capitalism or the investing landscape, and taking that kind of broad overall view. So I think that was one change, and I think another view is around social license to operate. All companies have some adverse impact on the environment and on certain aspects of society. No company is just positives, that's for sure. So really kind of thinking through the concepts of net benefit. Does the company create a net benefit to society, or is the company simply profiteering? So those were things that you kind of dealt with in creating the principles that I think are additive to this discussion.
I look forward to digging deeper into that. Kristin, I know that you've built portfolios with social justice and gender equity as core themes. What was a moment that made you pivot from traditional finance to purpose-aligned investing?
Thanks, Andy. Hello, everybody. It's great to be here. And so I grew up in a trading firm where we did algorithmic trading, high frequency, buy low, sell high, largely in derivatives. And when we ended up selling that business, there was time to step back and say what is needed. And what I saw at that time was that individual investors, endowment investors, large institutional investors all really needed a way to engage in public equities that was more meaningful, more purposeful. We do get the economy that we invest into. That sounds really obvious. And yet each one of us has a role to play. And so making it easier for every investor of every size to be able to invest into the economy that will work for all of us. So I started impact investing in 2007, and then NIA Impact Capital evolved from that as a way to support investors. And so very similar to what we've spoken about already is really just asking the question, what is needed for people and planet to not only survive, but to thrive together. And then what will the capital markets reward for? And that's really what we do at NIA is we start with the end in mind. We look for solutions-focused companies whose revenues are coming from the very solutions to our greatest global risks. And then we look for very well-managed companies. So that's where we weave in gender lens, I for racial equity, and social justice as well when we're talking about human capital management.
Manel, your forthcoming book reframes ethics as foundational to economics. How did the systems perspective alter your approach to thinking about portfolio design or asset allocation?
Well, I have to say that all science is grounded in philosophy, but there's a few group of sciences, the natural sciences, that we have somehow a world hypothesis that grounds them. But when it comes to the human world, I saw that what was missing was a human world hypothesis in order to ground the human sciences. And the most fundamental of all was ethics, the same as in the natural sciences was physics. And that's what got all this started.
And John, I want to ask you, there has been some pushback more recently on ESG. Where do you think we stand today?
There definitely has been some pushback on ESG. I think that the pushback actually predates the change in government administration in the U.S. And is, I think, largely rooted in challenges that we have with data. ESG data, I think, really created an environment where ESG investing was subject to challenge. You mentioned greenwashing in the intro. In addition to weak data regarding a company's impact on the environment, there's also data, information that companies provide or managers use that overstates positives. So I think the pushback, was made possible because of challenges in the information that investors have available to really understand a company's impact on the environment or really broader impact. I think that the industry, the investment industry, I think the sustainability segment has been working hard to address those issues and to attempt to strengthen the information set that we have to work with so that investment decisions can be viewed more logically. It can be easier to understand in terms of how that is changing a portfolio's exposure to greenhouse gas emission risk or climate risk or social justice issues. So I think it's beginning to be addressed, but I think there's quite a bit of work left to do. So those are some initial comments on the ESG pushback. I do think, Andy, that the outcome is going to be a stronger investment discipline, a stronger set of investment strategies behind sustainable investing or ESG investing. I think the data will be addressed, the disciplines will be strengthened, and I think that over the course of a fairly short period of time, the industry will be strengthened, but certainly facing some pushback today.
Kristin, any thoughts?
So the pushback has been really interesting, I think, in that, a couple of years ago, no one really knew what we did. This was very niche. It was over on the side. And now that there is pushback, people are starting to know what the letters ESG, environment, social government, DEI, diversity, equity, inclusion are. And they're starting to have opinions about that and starting to ask questions. And so, just as you mentioned, it is time for us to, as an industry, make some further definitions. For us, we see this both as a way to measure risk, as far as what types of, in the case of what types of risks could happen to your company based on the rate of climate change or the rate of extreme weather. It's also an incredible way to look at opportunities as far as where our industry and where our economy is going and where can we invest for that transition. Similar with the S, we're seeing definitely pushback about what does DEI mean? What do those programs mean? And yet there's some pretty clear financial research showing that diverse teams have stronger returns, are more innovative, and can actually have better governance as well. So it's an interesting time to be in this. And I don't say that I welcome the pushback, though I welcome the dialogue, and I welcome us all jumping in and really making some commitments about what does this mean, what are the best business practices, what are the best investment practices, and then, as we mentioned earlier, there's greenwashing too, so and pinkwashing, and how can we be really attuned and really get onto the same page about what we mean when we're talking about these terms.
Let's go to segment 2. We're going to talk about investment decision-making.
Investors assess companies through environmental, social, and governance criteria to determine financial risks and ethical standards. Strong ESG performance can attract investors, improve access to capital, and lower borrowing costs. Environmental factors focus on carbon emissions, renewable energy use, and resource management. Companies are expected to disclose emissions data and adopt sustainable practices. Social factors examine labor standards, human rights, and workplace diversity. Ethical supply chains and fair labor practices influence a company's reputation and long-term success. Governance factors cover board structure, executive pay, and transparency. Strong governance ensures accountability and ethical leadership. ESG scores, provided by agencies like MSCI and Sustainalytics, help investors assess corporate responsibility. However, standardizing ESG data remains a challenge. To avoid greenwashing, investors should review ESG reports, assess measurable actions, and verify claims against third-party audits before making decisions.
John, you mentioned data and a little bit of how things are evolving. Can you share maybe a story where including ESG data uncovered unseen risk or opportunity that traditional analysis would have missed?
Sure. And just the video clip that we just saw, I think, was great because it presented the factors behind ESG in the business context. And of course, as you listen to it, you as an investor, these are the things that you want to understand about any company that you would invest in. What is their ability to manage their impact on the environment? What is their ability to create a great workplace for men and women and people of all backgrounds? And what is the governance structure the company has? So, first and foremost, we should realize that these are pieces of information that we all want as investors. So including this information broadly should result in a much better understanding, of the company. Now, one of what you just asked is, can we give an example of when including an ESG risk, is helpful or useful? There are many situations where the ESG information comes out as a risk factor, in understanding that a company has a high exposure to a risk area and is either doing a good job managing that or a poor job managing it is sort of the basics of fundamental research and fundamental investment management. What's my risk exposure and how is this company set up to manage the risk? An area that's been in the news lately is healthcare sector, managed healthcare, and certainly we would see, a company like United Health as a company that has a set of governance risks, that has a set of sort of ethical risks in terms of how they interact with the Medicare and Medicaid systems, and so that's an example of a company that scored poorly on very specific ESG risks, and subsequently the stock did not do well. I'm sure we can find examples where it went the other way. Just full disclosure, Andy, no magic bullet here, but just kind of broadening the aperture from strictly environmental or moral issues to just opening it up to corporate risk that kind of fits into these buckets, and how making clear how important it is to kind of understand risk across the spectrum. How much has the company taken on, and how good are they at managing it is kind of the essential concept, I think, behind ESG management. And there are many examples. I just picked United Healthcare because it's been in the news and it's had a pretty dramatic stock move recently.
Indeed, it has. Kristin, as an institutional manager, what ESG red flags do you look for, and what can we learn as retail investors in identifying when, I guess, reviewing a corporate annual report, for example?
Sure. Well, so we do all of the letters, I would say, and we start with our 6 solution themes. So we are looking from an ESG perspective, how is a company baked? What are their revenues? And are they derived from one or more of our NIA 6 solution themes? And those are highly aligned with the UN Sustainable Development Goals. So we're looking at risk from the very beginning about how a company is baked. What are its revenue sources? What is its business model? Then we're going to governance, and we're looking to see, is the governance diverse? Is it qualified? And are there any risk areas? And are these basically the right people to get this job done? Are they going to get these products and services to market? And are there any brand risks that could be associated along the way? So we're looking both at risks and at opportunities throughout the process.
Manel, as a systems thinker, how do you see ESG criteria fitting into this broader ethical architecture? And do you think there are things missing from the framework?
Well, I think there's something fundamental, which is where ethics comes into the picture, in the sense that we should be measuring the realization of values and the reinforcement of counter values. We talk about risks. I suppose the counter values are included in risks, and opportunities. I see them related to the economy in terms of creating economic value. But what's missing is that we use purpose in both the positive way, but it's also related to the negative, because values and counter values are realized through purposes. So I see that there's a tendency to use purpose in the positive, and we don't realize that all systems, all human systems, realize a purpose, and that purpose can be an ill purpose because it reinforces counter values, or it can be a good purpose because it realizes values. And I see nothing of that in all the frameworks.
The idea of creating value for good, How do we measure that?
Well, let me jump in. I propose in the book, Universal Morality Hypothesis. It's not my values. I think the values shared by peoples and by civilizations, and it's something that we can inquire and we can think about what are those values. But if we look at the whole history of moral philosophy, there's some of them that are quite apparent, and all the philosophers, and I would say in all the different regions of the world, have a common consensus. So it's easy to start identifying what are those universal values, but we have to find a framework in which we are not missing and we don't have any loopholes, and we have to fit them in. But a good way to fill all those holes is by looking at the counter values, because all the moral philosophers agree which are those counter values, and since counter values are related to values, we can figure out the values afterwards.
And John, how can you incorporate some of the ESG measures? How can you apply that to valuation and risk management?
Yeah, and I do want to be clear that I think what Manel is working on is really fascinating and important in the concept of building a stronger capital market, if you will, that explicitly values positive impact on society broadly or the environment broadly. It is something that I think many of us aspire to. So I think that's a great body of work. In terms of incorporating these concepts into ESG investing, or just into kind of general portfolio management, I think there's a couple of lines of thought to introduce here. One of which is just the strict business line of thought. In other words, let's run with Manel's point, which is there's a set of values, there's a set of positive characteristics that society wants broadly, improving human well-being, improving equitable distribution of goods and services, et cetera. Let's assume that's there. Theoretically, companies that do a good job at advancing those values should, in fact, be more popular companies. We should want to buy more product from them. We should feel more favorably towards them, and we should assign a higher value to them. Manel, stop me if I'm off track here, but I think that would be consistent with your thinking. And so I think there's an element to that already exists. A company's reputation, its brand, the quality of its products, the news flow from the company, that all adds up and does have an impact on the value of the company and its overall performance. It has an impact in terms of who wants to go work there, right? Who wants to be affiliated with it or associated with it. The question of how do you take those ideas and get to a data set that you can actually use to differentiate one company from another, on these fairly granular points, is really where the challenge comes in. And the traditional ESG data, carbon emissions, et cetera, don't necessarily equate to the things that I just talked about. The typical consumer doesn't know what the carbon emissions of a particular company may or may not be. It's fairly arcane. So understanding kind of the overall mosaic of risks and activities that the company is involved in from a credible point of view, so that we can have a standardized set of information to work with that's well distributed. All investors are seeing it. That's an important step for this entire discipline to take. We have clients on one hand, and they want to invest with their values. They also want to perform and beat the market. And we're all working to serve them, and we're all looking for the information set that will properly inform us on it. if we have time, Andrew, I'll talk a little bit about kind of using, the information that exists that companies provide to do that. But I do want to acknowledge that, that set of information, which I think would be important to serving, Manel's concepts, and are also very, very important to serving the needs of the great clients that we have who are mission-oriented, kind of values-oriented investor. It's sort of one and the same. And the challenge is, getting the right data that can be appropriately incorporated into, investment decisions.
Kristin or Manel want to add to that?
Yeah, no, I completely agree. You got the point. I think there's a radical step to make, which is by realizing values, by definition, you counteract counter values. So instead of screening out things, we should be focusing on realizing values because we are already countering the counter values. And I think the frameworks are very ambivalent. No, you either look for something good or you avoid something bad. But I think by pursuing a good purpose that realizes value, you're already leaving behind all the other. And I think the concepts have to be, rather than ambivalent, they have to be reciprocal.
I would just jump in to say that I think many of us do want to invest with our values, and others want to invest prudently for the best return, what is a fair return, and which of these are material. When it comes to values, sometimes we're talking about best practices in human capital management. And, to an earlier point, who wants to work at these companies? So attracting, being able to hire, retain, and promote top talent, that could be a value, though it's really a smart business practice. And so how do we make a brand, a company, both palatable on the consumer side so that products and services fly off the shelves, and then also a company that people really want to work for and be associated with. And some of that is values, and some of it's really material management of the S and the G, and the E fits right in there as well.
Thank you for that context. It's a good segue into segment 3.
Investors often question whether ESG-focused portfolios sacrifice profitability. Research shows that ESG funds generally perform on par with, or in some cases outperform, traditional investments over the long term. Strong ESG practices contribute to risk mitigation by reducing exposure to regulatory penalties, reputational damage, and operational disruptions. During economic downturns, companies with sound ESG frameworks tend to be more resilient due to strong governance and sustainable business models. Studies indicate that ESG factors can serve as indicators of financial stability and long-term value. However, investors must assess ESG data critically, as rating inconsistencies and greenwashing present challenges. Impact investments in areas like renewable energy and sustainable agriculture demonstrate that financial returns and social outcomes are not mutually exclusive. Diversification, clear impact goals, and access to reliable ESG analysis help investors integrate sustainability into asset allocation without compromising profitability.
Kristin, talk about the performance versus the values, and maybe how do you evaluate risk-adjusted performance at NIA?
Sure. So that is the question of our times, right? Is what are we going to invest in, at what rate of return, and at what risk? And so I'll just call into question the way our investment economy is organized at this time, because largely developed in the 60s, really popularized in the 70s and 80s, is index investing. And so choosing companies based on a criteria like size or domicile, like the S&P 500, is largely our largest US-based companies. So that was an interesting kind of outcoming from what is still called to this day modern portfolio theory, yet it was developed over 50 years ago. And that theory did not take into account that we live on a planet with finite resources. I think that the men that developed that at the time were really thinking that we had infinite resources so we could have infinite returns. And the worldview is much different now. So which are those companies that we can invest in that are actually solving for some of these risks? And really bringing us to the next just and sustainable economy while making financial returns for investors and all stakeholders along the way. So that's really one of the ways we assess risk, is really starting from the beginning, is what are our largest global systemic risks, such as the climate crisis, healthcare crisis, education. One of the things that we look at NIA is actually wealth inequality. So we're looking at CEO pay versus worker pay. We're looking at what is a fair and living wage. We're also looking at access and timely access to healthcare for every gender across every state. So some of these are systemic risks that companies can actually solve for. And so we want to be invested into those companies that are actually solving for those risks.
John, when it comes to mindful investing, can you talk about active strategies versus passive indexes?
Yeah. And I think Kristin makes a point that indexes aren't necessarily perfect, and I agree with that. They're rules based, and they may include companies that aren't attractive investments because of the way the rules set up. So in an index, generally speaking, in an index, an investor is going to own an entire chunk, of a market, good companies, bad companies, everything in between. Whereas with active strategies, research has been applied to attempt to select the companies, that are the better companies. Certainly from a return perspective, our entire industry is focused on trying to figure out, which companies in the index are going to be the better performers. On this chat, we're really discussing about the relationship between how the company impacts society and the environment, as well as the return potential of the company. What's the relationship there, and how would you use that information, to select a better basket of stocks, for your client or yourself than what you can get out of an index. And I want to introduce, an important point here, which is, of the risks that we're talking about, risks to the environment, risks to social justice, risks to equality, et cetera. How do we understand which ones actually matter to a specific company? Yeah, I think we all care about these things. Most people care about these things. The question is, of these issues, which ones matter to which companies, how much, and where can we get the data? It's interesting. Companies, have always been required, or since the 1930s, have been required to provide disclosure about the material risks that the companies face. And they do that in generally narrative form. And there are, hundreds of pages in annual reports, in addition to the financial tables, which are really well organized in something that looks like an Excel spreadsheet, right? Then there's this entire narrative risk discussion, which is text. And the company has been required to disclose and discuss its material risks. That's a treasure trove of information, I would say, in terms of understanding the risks that the company has decided it must disclose to investors based on the regulatory format. And most ESG risks are included in there. So in terms of, how do we take the concept of we want to own the right companies that are, doing better things, managing risks better, how do we solve that challenge? I think the first place to go is, through a comprehensive understanding of the risks that the companies have acknowledged and described, in their legal and regulatory materials. And that's a great way, I think, to also hopefully avoid greenwashing and deal with the overall data issue, so we can work with a set of data that we have confidence in, that hopefully is spot on in terms of the issues that our clients are trying to grapple with.
Manel, your work reframes good investments. And I'm wondering if we're looking at an investment redefined as valuable because of its ethical impact, can we measure that on a quantitative or qualitative basis?
Well, you can measure anything you can realize. So something that's lacking, obviously, if it's not there, you could also measure it. Counter value is already telling you that there's something measuring that needs to be measured, because something is lacking and something that could be realized. So since they are paired together, even if you can't deduce one from the other because the more fundamental is the value, you could measure if something is lacking very, very easily. So I would say yes. And another thing I wanted to add is that values and counter values are all related. So most of the counter values are feeding some other counter values. So you could start with one and start finding the others. So that's also very important, because sometimes we are one-sided and we just focus on one specific issue, and sometimes we think we're doing good, but that bias is leaving the whole framework out. So I think we need a comprehensive framework and start filling in all the gaps and getting all that data, because it's there.
And just a question for the panel. One of our previous guests, Charlie Bressler, when he was on and talking about his investment philosophy, he was actually de-emphasizing the importance of performance, because he felt like, well, if he earmarks part of his portfolio, he just wants to do good. He's not worried about the performance metrics. Do you think that mindful investing sacrifices profitability?
I can jump in here. So mindful investing doesn't need to sacrifice profits in any way. Mindful really just means conscious. And so being conscious of where your money is, so that we are able to know what we own, and then ideally be really proud of what we own. And yet, if you have an idea that you want a certain theory of change, then you're going to want that business to actually do what it does into perpetuity, or at least so that it grows big, so that change happens, right? So you want those revenues. If the revenues are being defined or derived from purpose or mindful or whatever the investor wants to exist, then you're going to want, we as investors want to see a really strong governance and really strong talent, being able to attract and retain top talent. And then possibly, if this company is providing some of the best jobs with some of the best resources, healthcare benefits, really positive, fulfilling jobs, then you're going to want that company to provide more of those jobs. And so you're going to want that company to do well. And if that company's doing well, it's going to put off a profit, So yes, you could just invest in something that feels values based, and yet, just like you're giving money to a nonprofit, you want to make sure that they're organized and doing the job right. So that's how we see it from the NIA side.
Thank you. I don't know if anybody else wants to chime in.
Can I jump in?
Absolutely.
I would say that creating economic value is intrinsically linked to values, in the sense that if you don't make a profit, you won't be able to realize values. I mean, if you stop operating because you can pay for jobs, or you can't really pay for the supplies, then you're stopping your activity and your purpose is not realizing values. So I think that's very important, not to think as a trade-off, as like, if I want to make money, therefore I'm going to risk society, because I think the money is a consequence, or the profit is a consequence of purpose, and that's very important.
Thank you. Let's move on to segment 4.
Greenwashing occurs when companies exaggerate or misrepresent their sustainability efforts. Common tactics include vague claims, selective reporting, and marketing that focuses on minor improvements while ignoring broader negative impacts. Investors can identify these issues by seeking third-party certifications, reviewing independent reports, and analyzing a company's full operational history. ESG data can be inconsistent due to varying methodologies in selective disclosure. Without standardized reporting, companies may present only favorable metrics. To verify impact reports, investors should assess transparency, look for measurable commitments, and cross-reference multiple sources. Regulatory bodies and industry organizations are introducing stricter ESG disclosure requirements to improve accountability. Certifications and independent audits help establish credibility. Investors should approach claims with scrutiny, compare rating systems, and use investigative research to ensure they are supporting companies that align with ethical and sustainable practices.
Manel, you warn against superficial ethics. Have you come across egregious examples of greenwashing in your research?
Well, it's full of it. I mean, all these claims that doing good by doing well, like making someone rich and being positive to the world. I think greed is somehow seen as something, if it's legitimate, if you've earned it, you've done it legally, it's good. So you don't have to be ashamed of it. And so it's somehow that we don't question that. It's like we have the triple bottom line, and we think, oh, we have to do good and also make a lot of money for our investors, and that's something legitimate. I don't think that we have to accept something that's a counter value as a value. And making a profit is not necessarily being greedy, but there's ways to make a profit, and those ways can improve the world, and those are the legitimate ways. So money is not actually the issue. The issue is like sacrificing everything for the sake of making money and destroying our world by doing that. So I think that's a claim that we always say, well, we have to make money and that's good. Well, I don't know. I think money is a consequence of doing something good, but it's not good. It's in itself.
John, how do you evaluate a company's credibility on its claims?
Well, the video clip you played was great because it really said take all of the sustainability information that the company is providing with a grain of salt. Verify it, challenge it, and be careful when you compare one company to another because they might not be comparable. And that's a big difference between the data or the information that a company voluntarily provides and may provide in a marketing sense versus what a company files with its primary regulator. In the U.S., that's the SEC. So I tend to rely on information in the Amherst product area that companies have filed with their regulators under Reg SK in the U.S. and using the IFRS standards outside of the U.S. And there's a massive amount of that information. It needs to be structured, analyzed in order for it to be useful. But once that's done, you can have a fairly strong picture of the company's risk profile. And then that information can be tested to understand its impact on firm value. Essentially, how is the market valuing the company's management of or exposure to a specific risk and the company has provided us with that information. So I think that's important. And in terms of, I want to connect it to Manel's, some of his comments, because the market does place a value on these things. The trick is understanding what that value is. Where has the market gone to get the information? And they've either assigned zero value to it, they've penalized a company to it, or they paid a premium for a company because of it. And I think that's really what's necessary today, I think, to really adequately serve a mission-oriented investor is a very strong data set that we can look to and explain, here are the specific risks and here is the impact on that company's value. The market likes this risk, the market doesn't like this risk, the market assigns no value to this risk. I think that's critical. And I think for our clients, who I think are some of the best clients in the world, who want to align the portfolio with their mission or values, it's very, very important to kind of walk through that and do that very carefully. And that may necessitate a discussion. It's possible that the market isn't as concerned about greenhouse gas emissions as my client is, right? We need to have that discussion so that we're doing the right thing. That are we going to actually penalize a company for something the market is paying for, so that we can at least do this with total awareness.
Kristin, how does NIA define and detect greenwashing beyond surface level ESG claims?
Yeah, it's such a good question. So when I started building these portfolios in public equities in 2012, one of the criteria we had at that time was that somewhere on the website and in the marketing materials, we wanted to see a nod to sustainability. And that was one of our criteria. Now that would be impossible because literally every website, if you look on it, is green, with plants and with colors, and it has DEI photos on it. So So that's just kind of the style of the website now, and it's the style of the materials is to make it look sustainable. So we really do emphasize the revenues. Where are the revenues coming from? How is this business baked? And across our 6 solution themes, that's how we tell really where what's happening. And then, of course, we dig into materials. We do seek to engage with every company. So we're asking them, all of our companies, to report on their scope 1, 2, and 3 emissions, all of their carbon data. We're also asking them to set carbon neutral deadlines and target zones. And then we're asking them specifically for their plans. And so the proof is really in the pudding is where are their carbon numbers now? Where are they looking at, particularly in scope 3, where that has to do with basically their value chain, what's upstream of them, where are they getting their parts? Are they coming from getting shipped? Are they getting shipped in single-use plastics? All sorts of questions about doing kind of that internal audit and asking them to progress. And in that work with our companies, we're really able to see which ones are dedicated to this and which ones we're here for the window washing.
Thank you. We're going to bring it home and go to segment 5.
Financial institutions are integrating ESG factors into investment strategies, responding to regulatory shifts and investor demand. ESG-focused funds are expanding, and AI-driven analysis is enhancing data accuracy for risk assessment and opportunity identification. Blockchain technology is improving transparency in impact reporting by tracking supply chains and verifying ESG claims. Regenerative finance is gaining traction, emphasizing nature-based solutions like reforestation and sustainable agriculture. Unlike traditional ESG investing, ReFi prioritizes restoring ecosystems while generating financial returns. Governments are advancing policies to standardize ESG disclosures and incentivize sustainable investments through tax benefits and subsidies. Mandatory reporting requirements are shaping corporate accountability. Key investment areas include renewable energy, sustainable agriculture, and biodiversity credits. Staying informed on evolving regulations, fintech advancements, and impact measurement tools will be crucial for investors positioning themselves in the future of mindful investing.
Kristin, how do you see gender and racial lens investing evolving in the next 5 years? Will they become mainstream or remain niche?
So, Andy, that's such a good question, because with the pushback to DEI, companies are largely, we're seeing where they stand. We're seeing where they stand about, are they going to prioritize diversity in leadership? Are they going to prioritize a healthy, active, and inclusive workforce? That's one way that a gender lens shows up. I would say certainly with the wealth transfer that's currently ongoing, where the large amount of investable assets are being transferred in our lifetime right now in the next 10 years, largely to women investors. And our hope would be that the industry also shifts with that, so that women are in the driver's seat of their own investments, where it would be a natural thing to ask. And this actually, I think the smart men are already onto this, as far as wanting to see a diverse executive leadership team and a diverse board, because they're making better decisions and making stronger ROI, more innovation, et cetera. So where is a gender lens about values, and where is it about really material issues within a company? I think that's going to be really important. And then when we're looking at products and services that are beneficial to women, that's actually a really nice lens for investors to use, of all genders, because generally those products that are beneficial to women are beneficial to society at large. And so there could be a greater TAM, a total addressable market, when we use that gender lens. So that's been a really interesting way for us to literally capitalize on opportunities as well as reduce risks. One way that shows up has been interesting in the tariff wars, because we do have that requirement for all of the companies we invest in that they do have diversity in leadership on the executive team and the board. That largely keeps us out of China, where that isn't a common practice. And so when there are tariffs this high this week and maybe not next week, and maybe it's going to be different that week, we have stayed a little bit out of that volatility, which has been really nice. So using the gender lens can be advantageous to all investors.
Very interesting insight. Well, I will thank you in case you have to drop off. Manel, I love that you talked about just values driving the investment decisions and the company's decisions, that you can't just make a profit at any cost. If you're doing that while destroying the environment, there's going to be a cost, and it's not going to be sustainable. What philosophical paradigm shifts are needed to transition from sustainability to regeneration?
Well, I would call it, we have to shift from an extractive economy, which withdraws all the resources towards purposes that reinforce counter values, to an ethical economy in which the resources are directed towards caring about others. Because at the end of the day, ethics is about caring about others. And that shift has to come from realizing ethics is not like a moral imperative or like an obligation, but it's something out of the heart. So it's something that you do it out of love, and not out of a duty, a moral duty, as a norm, as a rule, because it's something that you do, and you appreciate doing it. So it's not something that you sacrifice. It's what drives you. So values, at the end of the day, come out of the care for others, and I think that's what should be reported. Because when you are seeing counter values, you're seeing the opposite. You're seeing that it's otherwise. It's like hate, indifference, pity towards others, and trying to brainwash. I can say it directly, about trying to say, look, I do so much on one side, but then I do this. So I'm a good person and I feel great because I'm greedy, but on weekends I do something philanthropic, or every year I do something volunteering. And I think that's what we should stop thinking, because ethic is something we do every single day. And purpose is not something we do on an occasion, or something we do out of generosity. It's something we do from the minute we wake up every day.
John, what do you think? Can we lead with love?
I don't know about leading with love in particular, but I do think that the concept of business ethics and kind of factoring in the overall needs of society and the planet are what we were getting towards with things like the Sustainable Development Goals. It's kind of at the heart of sustainable or ESG investing. And I think one of the points that's come out in this session is how important it is to do that in a way that works within our existing financial system. And I think Manel made that point nicely, because the company still has to be in business. It has to compete for capital. It has to put money to work efficiently and effectively. And so this is an incredibly important topic because it gets at the quality of life for the entire planet. Companies have an impact on well-being for people that never buy their products, right? That live in different countries, et cetera. And so kind of bringing that element into firm valuation and security values, I think it is happening. Being able to analyze it and understand it is an important step. So, Andy, I would say that some of this is being done. The market doesn't place zero value on ethics or negative value on high moral standards. Being able to understand how the market is doing that and being able to then use that information to create the right portfolio for a mission-aligned investor is really critical. And I think that science, that data set, that is advancing. And despite the current, ESG pushback, companies are continuing to advance these disciplines. So I think one of the great things that's happening is that corporations are actually continuing to make progress in terms of improving their operations, reducing their adverse impacts, and really trying to build a better future, because they understand there's a connection between value and values, and they understand they have to have the purpose that Manel has talked about. So thank you.
Thank you. Just a call out to the Inspired Moneymaker audience out there. We did have Andrew Behar on a previous episode, CEO of As You Sow. So look up that episode. I'll put that in the show notes. Excellent resource for being able to screen different mutual funds and investment choices, including those in your 401k. Last question for you, John. I know that you do use data science. How do you see AI and big data improving ESG risk detection?
Well, I think very, very, in very, very important ways. So, as I've mentioned, companies produce a lot of information through their regulatory filings. We were talking about greenwashing earlier, where the company is advertising or they're creating some marketing-oriented report. There's a different set of information that's in the court system. There's a different set of information that's in regulatory documents, which is very, very important to get through, but it's thousands of pages, it's dense, it's not structured. AI in data science and machine learning can assist domain experts in processing all that information and really being able to use that information to understand the risk mosaic that a company really is. So, Andy, I think AI used properly, data science used properly, definitely is a critical tool for this work. And as we all know, AI is achieving new milestones literally every day. 2 or 3 years ago, it was less useful of a tool. it's become a useful tool. It's going to become a more useful tool as we develop additional capability. So I think in a big way, and I think that combined with domain expertise will solve some of these challenges, create greater transparency. One of the things that we really seek is transparency. If we could really understand, the company's motivations, its impacts, its exposures, it'd be easier for people to parse value and make these decisions. AI and data science, create the tools to take significant steps towards creating that transparency.
And Manel, your upcoming book, you frame ethics as core. How do you see blockchain, AI, and other tech? Is it supporting or threatening that vision?
I think all technology can be useful, as I say, purpose driven things. I mean, if you use the technology in the right way, there's no problem. The problem is when you want to reinforce something through technology, counter value. So I think we should be very careful about that because technology can be used in the good way, in the bad way. So it's morally neutral, I would say. It's like purpose. It depends what it does. You can, I think I should stress because maybe I haven't said what I mean by purpose, but purpose is what a company does for others on a regular basis. And what you do for us on a regular basis can harm or it can do good to the world. And technology can be used for both things. So I think we should be careful not to use the technology for the wrong purpose.
Well, we're going to leave it there. I want to thank our panelists and our audience for that insightful conversation. One of my favorite takeaways is that this idea of mindful investing, it really marries a philosophical approach to the real world. And I love that John talked about we have to implement this within the framework of the existing financial markets. So I love that, this, you're marrying like idealism with what we have and always try to make our best effort. And I see that every investment we make can be a vote for the future that we want to see, whether it's in public markets, private equity, or community-based initiatives. Your capital does have power, and mindful investing means using that power with clarity in intention. Inspired Moneymaker, if there's one thing you can do this week, I want you to focus and just pick one thing because positive change requires action. Take a look at just one investment that you hold and ask yourself, does this align with my values? Dig into it, look beyond the ticker symbol, who's leading the company, what do they stand for, what's their environmental and social footprint. That one moment of curiosity might just spark a broader shift in how you view and shape your portfolio. If you found this episode helpful, please share it with a friend, leave us a review, and let us know what mindful investing means to you. Your voice adds to the momentum of this movement. If you're on LinkedIn, follow me at Advisor Andy. Inspired Money is created and produced by me, Bradley John Eaglefeather. Bradley is behind the scenes doing the live stream, and he edited the segments. Chad Lawrence does our graphics, animations, and editing. Before we part ways, I want to give a big shout out to our amazing guests. If you found value in today's episode, go follow their work and keep learning from the best. John Streur, you can follow John, his ongoing work at Boston Common Asset Management, where he leads Amris strategies focused on integrating material ESG risks and opportunities into investment decisions. Thank you, Manel Pretel-Wilson, PhD. Keep your eye out for his forthcoming book, The Ethics of Human Systems, Creating Economic Value with Impact for Good, which releases August. And it's a real fresh systems-based look at how ethics and economics must evolve together. You can find more of his academic work at ResearchGate. And finally, Kristin Hull, PhD. You can follow Kristin's work at the intersection of finance and justice at niaimpactcapital.com. Kristin and her team are leading the way in gender lens investing And if you're looking for an investment approach that aligns with your values, NIA is a great place to start. If something sparked your interest today, I encourage you to follow our guests and check out their organizations, dive deeper into their work. Thank you, both of you. And thanks for tuning in, Inspired Moneymaker. Remember, your money has power. Use it mindfully. Inspired Money returns next week on Wednesday, July 16th at 1 p.m. Our topic will be retirement wellness and financial planning, nurturing wholeness in life's new phase. I'll see you then. Until next time, do something that scares you, because that's where the magic happens. Thank you, everybody.